There's only one way to find out.
Only one way to know.
Oh, it says the Goldfinger started a live video.
Is that us?
I think so.
Okay, perfect.
That's what we look like? Okay. Oh, jeez.
Off to a hot start.
Off to a very hot start. And we are back doing another Instagram Live. Thank you for tuning in. It's Max and Elijah from the Goldfinger Group. We are a real estate investment company based in West Los Angeles, focusing on purchasing value-add assets throughout core Los Angeles, as well as the South Bay. And we are here to talk to you today about building equity versus cash flow. So sometimes you have a building, you buy it, let's say for $1 million, it's making strong cash flow. What do? Do you just let the building cash flow? Do you sell the property and buy something bigger? Do you refinance and pull the money out and use those funds to buy another property or use it for another purpose? And the short answer is, like
yes.
Most things in life, that it depends.
Yeah.
It depends, and everything is case specific, scenario specific, and you could have the same scenario with the same property, but two different people that have two different agendas, both within their personal and business trajectories, I guess you could say, right? Like where they see their lives going, both business and personal, career, etc., over the next couple of years. And those two people who have the same exact property with the same exact income, same exact location, the same exact loan amount, two different people may make two completely different decisions. And that's why Max and I are here to talk to you about the two different decisions that we're gonna make. No, that's a joke, it was a bad one. And that's why Max is gonna take over the conversation.
Beautiful. I think the most important thing is that everybody has their own strategy, and there's multiple solutions or multiple ways to get to the same final goal, and it's a matter of what you're looking for. And the first thing I want to state is that buildings are investments, so they're treated like a business. And specifically for us, all the properties we own, I don't want to say all, like there are some properties that are owned by the same LLC, but we create new LLCs to own each property, and we have different investors in each one, and each one has a different game plan, a different strategy of what we're going to do with it. And so, yes, these buildings are investments. And what does that mean? Is they're valued based on the income, right? Nobody's going to buy a property where they're not making money. They'll go invest somewhere else, right? There has to be a reason why somebody's going to invest in real estate. And I think the big thing is they trade off income kind of like stocks, right? Stocks trade on price to earning ratios. Buildings trade off, well, how much cash flow is it making? There's multipliers to look at, well, what's the value of a building? So, with that in mind, that buildings are businesses, there's multiple ways to then make money on your investment. And what we're talking about is you can build equity in a property, which is basically your net worth, right? If you own, let's say you get a 70% loan on $1 million building, you have $300,000 of equity of capital in the deal, that's your net worth for that property. Or you could be cash flowing off a property, right? You're making income that the property's producing after it covers your expenses and your debt service, and you could be making $2,000, $3,000, $4,000 a month, depending on the size of the building, and that's money that's going into your pocket, into investors' pockets every month, every quarter, every year. And so what we want to look at is, well, what does equity mean, and how can you make money in real estate through building equity? And then how can you make money in real estate through cash flow, through monthly, quarterly, annual cash flow?
Right, and just to clarify, what you're talking about, the buildings being, the value of the property being based off of cash flow, it's both current and pro forma. So we'll buy buildings a lot of the times where there's very little to no cash flow. It could be a very high vacancy in the property. It could be that there's very low paying tenants. Could be that there are tenants that are not paying, especially during COVID, a lot of delinquencies, people that have back rents, balances of rent that they haven't paid that still do. So the general concept is that people are buying these properties for cash flow. However, it's not always immediate cash flow. It's cash flow that can be obtained through working the building and achieving the upside, capturing the upside in the property. So we may buy a building for $5 million and it's literally making no cash flow, right? Especially with some of the aggressive loans that we get. No cash flow, and by the time we sell it, it's making very strong cash flow for the next buyer, and we may have only captured a couple months of cash flow, but what we've done there is we've built equity. So we bought it for $5 million. We've let's say spent another $1 million on the property, so we're into it for $6 million, and we sell it for $8 million, right? So we've made $2 million after sales costs and everything. You know, maybe we made 1.7 or whatever, but we make that additional equity, right? So we bought a property with no cash flow. We've worked the building, repositioned it to a point where it has strong cash flow. At that point, we'll sell it to someone who's buying it for the cash flow. And what we've done there is we have increased our equity position, right?
Exactly.
And we've captured the equity through a sale, and sometimes we'll do it through a sale, and sometimes we'll do it through a refinance. We'll put a new loan on the property. And a big question that comes up, that's coming up for us on a couple assets right now, is we have prepayment penalties on a few of the buildings that we've stabilized, and some of these prepayment penalties can be pretty hefty, and sometimes it's worth it to go back to the bank and see if they're willing to put a new loan on the property, a larger loan on the property, and work with the bank to achieve a new loan, and also work with them to structure it in a way where they'll waive or reduce the prepayment penalty. So we're getting a little off topic, but
no, I think it's all inclusive, and the big part, and we've done this over the past few years, and I think a lot of people starting out early in real estate is you go out, you buy $1 million property. There's two ways to get appreciation to build your equity. There's natural appreciation, right? Real estate probably is making 3 to 5% depending on what market you're in. But there's other markets where it's like, hey, it could be 1 to 2% a year. And I think the reason why LA real estate is so attractive is because you have so much natural appreciation just by doing nothing, just by owning the real estate. So you have natural appreciation and you have forced appreciation, which you discussed. So, you know, you increase the property value, you improve the property and increase its value. So if I buy it for $1 million, I can sell it for $2 million. Now with the $2 million exit, I could go buy a $3 million property, do the same thing, now sell it for $5 million, now go buy an $8 million, like you said, and you do that enough times over 5, 10, 20 years, and you've grown your portfolio from a $1 million building to $50 million or $100 million, depending on how active you are. And that's what building equity is. It's increasing your net worth through buying and selling properties, increasing their value, and getting the two types of appreciation. And then it transcends into cash flow, where, you know, we're selling it to people that want the coupon every 3 months, you know, every year. Maybe, and I think the biggest thing on cash flow is, well, what's my cash on cash? If I have to put down $1 million, am I making $10,000 or am I making $100,000? And it's a way to compare assets, right? If you look at the stock market tends to go up about 7% a year, you know, versus what real estate's doing is you get the appreciation, but you also get the cash flow. And I think that's where the balance comes in, is comparing the cash on cash versus other assets that you could be investing in.
Yeah, it's interesting to see the life cycle. I mean, you're talking about 20 years it takes to, you know, build up to be in a position where the cash flow is so strong that it becomes a meaningful driver within the business. And so we actually have sold a couple of our properties to a family that bought some really tough buildings back in the mid 80s and in the 90s. They bought larger buildings in downtown and Westlake, and those buildings were really, really tough, and they worked those buildings and they stabilized those assets, and they were really hands-on investors. And they've gotten to a point right now where they have a lot of units that they've stabilized, and those units are giving them lots of cash flow, to the point now where they're buying stabilized buildings from us. So they were buying, back in the 80s, they were buying buildings that were distressed and repositioning them, turning them around and getting them to cash flow, and then pulling the money out of there and then buying more buildings. Now, years and years later, they still have these properties. They've held on. They've sold some, but they've held on to a lot. They've refinanced, but the equity's built back up. They have really strong cash flow from these properties. Every year, they use that cash flow to buy 3-4 additional prime assets that have already been repositioned by young guys. Well, you're young. I'm in my mid-30s. So, but people who have taken the time to work the buildings and turn them into trophy properties, and so it's kind of a luxury position that they're in because they have all this cash flow. But they're essentially taking their cash flow in order to purchase more properties, which they are, like you said, basically banking on appreciation, as well as whatever cash flow the buildings spin off, and they'll probably just keep doing it forever and ever as long as they don't get bored of it.
Exactly, and I think what you alluded to earlier is that the ideal situation is to buy these buildings at the right price, get the appreciation, both natural and forced appreciation, and then cash flow from there because you've built your equity position and you've increased your cash flow. And I think something that we've looked at, and I don't want to speak so much for you, is if you can start at $1 million and get to, let's just call it $10 million, and you're making 10% on your money, 10% on $1 million is $100,000 versus 10% on 10 million is $1 million. So it's like, why not increase your equity position so that at a certain point when you are cash flowing, your cash flow is going to be significantly higher than it was when you originally started.
Right. And the question always comes down to, well, what do I do in the meantime? Well, you live with 3 roommates and you eat ramen, and you got to make trade-offs, but you also got to live. So maybe you sell something, maybe you refinance, but you don't reinvest all of the proceeds and take some of it to live off of. Maybe you flip a house and make money that way. So you definitely need a short-term plan as well as a long-term plan. But it's like you said, if you're starting off with a small amount of equity, generally what people do, ourselves included, is buy something, fix it up, sell it, build the equity to the point where the equity gets to a really large number, whatever that is, and that equity, like you're saying, the 10% on the 10 million is $1 million. Once you have that $1 million coming in, okay, so every year you can have $1 million coming in, you live off of 300-400, and you take the rest and buy 1 or 2 buildings, whatever it can buy you. So that's basically what the trajectory that we're on, and we keep seeing opportunities to add value and then either refinance, take the money out, pull money out, or sell and get into bigger deals.
Exactly. So equity, cash flow, refinancing. It's definitely nuanced, and I think the big thing is understanding these concepts and how to navigate. And I think that's where we have a lot of expertise is navigating in this space, specifically Los Angeles real estate, and understanding the markets and understanding where we see value, how to create value and build our equity positions, and also how to cash flow from there. So
sorry to cut you off.
Please.
Just one other thing in terms of appreciation, right? So one of the ways of building equity is inflation, right? So real estate's a great hedge against inflation. So rents go up as a result of inflation, property values go up as a result of the rents going up, and then appreciation in the area. But we generally don't build an appreciation into our business models for the properties because we don't know at what rate something's going to appreciate. But there are exceptions where you do know that there's a new development coming in that's going to add lots of jobs, and something like that is not just a blanket it's not a blanket function in Excel. Oh, it's just going to appreciate 3% a year. It's like, no, we actually know that there's going to be more jobs. It's a area that's hard to build in, and therefore the rents are going to go up as a result. So I just wanted to make that clarification. Hope that this was informative. Anything else to add?
No, that's it for me.
All right, very good. Well, again, I hope this was added some value to you. If you have any questions or if you have any deals that you'd like for us to look at or interested in working with us, I would be delighted to hear from you. 323-873-9332. Or
Good thing you don't know mine.
Yeah, I don't know Max's, but somehow we're WhatsApp together. But you can also DM us at the Goldfinger Group or at Elijah Karak. And thanks for watching. Take care until next time.